17th.
Got it.
Hey, Angie.
Happy belated birthday, Laura. Happy belated birthday.
Thank you so much. I just turned 68.
Congratulations.
Sue, let me know when we're ready.
Okay. Okay, we are live and we got Bobby coming in, so.
Welcome, everyone, to the investment committee for this month. If I don't get a chance to say it, I want to say happy Thanksgiving to everyone on the call and wish them warm blessings for the this holiday season. But Sue, can you take roll call, please?
Yeah, Angela Banks. Here. Christina Bennett,
Present.
Antoinette Cousins, Lewis Cross, Sheila Goodwin, Donna Jones, Yvette Levy,
Here.
Bobby Richardson,
Present.
Albert Sanders, Justin Stein, Doris Walker McGahee.
Here.
Okay, so we have 5, so we have enough for a quorum.
Thank you, everyone. Today we have a short meeting. We're going to go over performance. And I do not have the agenda in front of me, but NEPC, Deandra's on the call. If you can jump right in, I'd appreciate it.
Sure. I just want to mention, I think this is one of the first meetings I've had where it's all women and all women of color to talk at a client level. So this is kind of refreshing for me. Sue, is it okay if I actually share my screen?
I have it up, Deanna.
Okay, all right. That's okay. So if we could go to the next slide. So what we'll do today is I'll talk about the broad markets and kind of what happened in the broad markets, and then I'll trace that back to your portfolio. Please stop me if you have any questions or if I'm going too quickly. Apologies, the page wasn't ready when we had to produce the IPA, but for the to date period. So we're talking about Q3 September, the third quarter of the month. What you saw within the markets, within the equity market, so these are your stocks, you saw kind of a couple of dynamics. So the uncertainty around the Delta variant definitely impacted a lot of consumer behavior. So you saw that impact within a lot of the consumer stocks. But you also had this interesting dynamic, and I'm sure a lot of people have heard about it. The bottleneck or supply chain have become kind of buzzwords within the news cycle. And effectively what that means is that pre-COVID, there was already a small kind of supply chain bottleneck. And you saw this particularly within things like automotives and manufacturers, where the components, the individual components. So if you think about the components that go into a refrigerator or components that go into a car to make it actually function, there was already a little bit of a backlog behind the demand for those supplies and the actual supply of them. So for example, if you think about buying a new car, the components with that go within the door that make the window go up and down, there was a backlog between manufacturers putting in orders for those components and actually receiving those orders. It was a backlog. COVID then effectively shut down a lot of travel, which created an even larger backlog with those components. And then post-COVID, you're seeing an even more pronounced backlog for those components, and you're seeing it in a lot of the industrials, a lot of technology companies, but you're also now starting to see it on the consumer side. And effectively, what that bottleneck is doing is halting the supply of items that people need to kind of continue to participate in the market. So, and if anyone listens to like CNBC or CNN, you're hearing a lot of people say, buy your Christmas presents early, which is true, buy your Christmas present early. So if you think about just basic supply and demand, when there is any bottleneck of the supply, so suppliers aren't matching the demand, it inflates prices. So on the consumer side of the market, what you're seeing is that the sales that were typical of last year, or Black Friday sales, are just not as great as they are not as great this year as they were last year and the year previously. And that's causing consumers to spend less in the market. So effectively what that translated to is you saw some of the companies that had done well in the pandemic who had low balance sheets, typically were good stocks, specifically within that value bucket. You saw them not perform as well because of that bottleneck. On the international side, you kind of had two dynamics happening that impacted more specifically emerging markets than anything else, and that was China. So China had kind of two big things happening. So the first thing is the Chinese government changed regulations for publicly traded stocks, and effectively what this regulation change meant was that they were trying to fight against monopolistic behaviors within companies. So if you were to look at some of those indices, and you see them kind of listed out here, if we look at the MSCI EM indice, which is representative of the emerging market space, a lot of that is China, and a lot of what is captured in that Chinese geographic region for that indice are big names like Alibaba. So when you think Alibaba or you hear Alibaba, it's essentially like the Amazon of China. It's a large e-commerce platform where you can go, similar to Amazon. I can buy baby diapers on Amazon, but I could also buy a couch on Amazon. That's what Alibaba is. And then like things like Tencent and all those big Chinese companies, effectively what the regulations did was told them that they cannot be as big as they are, and they also received a fine. So what that creates is kind of this uncertainty about these large companies, what they're going to look like in the future. The other thing that happened with China, and if we could go to, sorry, Sue, to have you flip around so much. Could we
That's
go
okay.
to page 13?
Okay.
Oh, I'm sorry. Actually, if we could go back up two slides. Sorry. So page 11. So the other thing that was happening within the Chinese market was a company called Evergrande. Evergrande is a large real estate developer and real estate owner within the Chinese market. Effectively, what they came out and said was that they hold so much debt, they are not going to be able to pay back their debt holders. So if you think back to like the credit crisis, where it was a lot of uncertainty around if the government was going to bail out Goldman, and if they bailed out Goldman, does that also mean that they'll bail out Lehman Brothers? There's a lot of uncertainty injected into the market because, one, Evergrande was very clear about them not being able to meet their bondholders' coupon payments for the long term because they held so much debt on their books. But the Chinese government tends to err very conservatively around how they operate with companies and if they bail companies out. And so because of that, you see this line, which is representative of their bond price, and you see it just continuing to trick down, right? Because they can't pay their debt holders. So if you think about like a credit card, if you call your credit card company and you say, hey, I'm not going to be able to in perpetuity pay my credit card bill, your credit score will go down. And that's effectively what happened with Evergrande. Their credit score went down, but because they are such a large player in the real estate market and they own somewhere around 20 to 25% of the Chinese real estate market, and it's not just on the institutional side, they also own a lot of apartment buildings. They own, and I forget the Chinese word for it, but it's effectively row homes, single family homes. They own a lot of that. It injects a lot of uncertainty into the market, and specifically how these companies are going to be able to maintain housing or maintain their retail space if their realtor, effectively their landowner, goes out of business. So what that does to the market overall is you saw a decrease in emerging markets from the pressure from China overall, just because of those two situations, but also the broader impact on the Chinese market. And then if we switch over and talk a little bit about debt, or the Barclays Agg. So yields continue to be compressed. It's an inflationary environment. So typically in inflationary environments, you see stocks outperform bonds. And that's exactly what you saw for the quarter. And we'll talk a little bit about October too, but you saw a similar story in October where the yields on bonds were significantly compressed. The one bright spot within bonds, which actually helped you all's portfolio, is that plus sector. So I'm sure you've heard us talk about it before. When you think about like just core bonds, that's your treasuries and your mortgage-backed securities, your very high AAA rated securities. You all have an allocation to fixed income managers that can play outside of those kind of core conservative safe haven bond exposures, and that really benefited your portfolio for the quarter. So I will pause and see if there are any questions on the market, and if not, Sue, can we go to page, I believe it's your page 17. Okay, hearing. Oh, I'm sorry. Was there a question?
No, I was going to ask, is that the page you want?
Yeah, this is the page. So is there a way to make it a little bit bigger?
Yeah.
Perfect, thank you. Pregnancy eyes, I don't see as well. I thought it was a myth, but it's actually true. And so for the 3-month period ending September 30, you'll see that the fund was down around 50 basis points. And you'll see kind of three different bogeys that we put into your performance report to help you understand why performance looked the way it did, but also kind of help you compare yourself to peers. So the first one is your allocation policy index. So that's the allocation index, and you'll see that that was flat for the quarter. What that index is representative of is if the plan was 100% passively invested in all the asset classes, perfectly invested based on your asset allocation policy, right? That's not effectively what happens for a number of reasons. The market moves, so you'll never be just 100% allocated the way your policy is set up. Secondarily, you all have allocations to private equity and real estate, which are drawdown structures. So you make a commitment similar to what we did at the last meeting, and over time, normally around 18 to 2 years, somewhere around there, the manager will call that capital that you invested. Functionally, what that means is that it will take you time to get to your bogey. And if you look at the bar charts down at the bottom where it says allocation versus target, if I could draw your eye to private equity, right now you're around 4% invested in private equity. Your target is 7%. Real estate, your target is 6%. Your target is 7%. You're around 6% invested. So when you think about that allocation policy, what that means is that because you all are not 100% in line with all of your allocation policies, you can effectively be hurt. Performance can be hurt by that. And that's what happened in this situation, is that real estate and private equity, to a lesser extent, some of the other things that you all were invested in, outperformed for the quarter. And because you all weren't 100% at your target for those asset classes, that hurt performance for the quarter. And then if we go to the next line item, which is your policy index.
Sorry.
Oh, I'm sorry. So you can
No.
stay on that page. What your policy index is indicative of is how active management, so those managers within your portfolio that are actively attempting to outperform, sorry, my kids are texting me, actively attempting to outperform their benchmarks, their bogeys that are set for them, how well they perform for the portfolio for whatever period of time. And so you'll look, you pretty much matched your policy index. We rounded a little bit. You were slightly ahead, not by a meaningful amount. But effectively what that means is that active management didn't help or hurt within the portfolio for the quarter. And that's to be expected. So if you go back to my earlier comments about the market commentary and kind of how the market performed, you all tend to be a little bit more of a value player within your portfolio. You tend to have a little bit more of a value tilt. You also have direct and indirect exposure to emerging markets. So it's not, it was within expectations that the portfolio will be kind of flat with regards to the alpha or the excess return from the active management. And then if we look at your public fund DB gross median index, so that is the average pension fund that is between 250 and 1 billion. Their return for the quarter was roughly, they were down around 10 basis points. That's at negative 0.1%. That it could be a little bit misleading, and normally we don't, unless it's a specific client request, focus on that median, the peer median in the short run. We look at it more on the like 3 and 5 year periods, and that is because similar to yourselves, portfolios turnover, there might be a bulk of those public funds that are similar to you all that change their asset allocation from year 1 to year 5. So we really want a smoothed out average instead of looking at kind of the shorter term periods. So if we go over 3 columns and look at your 3-year number, which is kind of the number that we tend to focus on the most, because that's most representative of if not a complete market cycle, close to a market cycle, that 3 to 5 year, you'll see that for the 3 year, the fund is meeting its actuarial rate of return. It's very close on that allocation index, and a lot of that has to do with where you are within the private markets, and you're outperforming, or I'm sorry, your policy index is you're underperforming your policy index, and some of that has to do with legacy managers that were terminated and taken out of the portfolio. So I will pause there and see if there are any questions about this page, and then this is your time, and I want to be respectful of it, so we can talk about individual managers' performance, or we can hop over into the due diligence watch list and manager update pages.
Let's go ahead and hop over.
Okay. So Sue, can we go to page? It should be your page 95. Perfect. So for the quarter, there was one manager update, which was TCW. The CIO of TCW is leaving the firm. The structure of TCW, and we have a hold on this, and that hold is not for St. Louis teachers. So specifically, that's NEPC's due diligence committee recommendation for all clients is that they hold this manager. So the structure of the TCW portfolio management team is that it's a very collaborative effort. So they do have a CIO that kind of helps create house thoughts, but they have a team of analysts and portfolio managers that work collaboratively. So we think there could potentially be some impact from the CIO leaving, but at this point, we want to kind of wait and see and figure out how they regroup the team before we say this is a termination or we take them off of the kind of hold watch list status. So I'll pause and see if there are any questions on that.
What's the update there? I mean, they're replacing him. He's retiring. What's the story?
So he is leaving. The official thing that they told us was for personal reasons. He's not, this sounds kind of flip, but he's not a young person. So I think this was kind of, they have thought about succession planning before. So it wasn't out of the blue, I guess. Does that help? I'm sorry.
Yeah.
It does, I'm
yeah,
sorry.
Construction. Okay.
Okay.
Yeah.
Perfect.
Can you?
And then if we could go into the next 4 pages, and I won't read this through to you all, just go over it very quickly. So this is the plan's watch list monitor. So there's kind of 2 bogeys that you all look for managers to hit to be considered for watch lists. And effectively what watch list means is that as your consultant, we pay more attention to them. So sometimes that's more commentary from them about why performance looks the way it does. Sometimes it's just, we get on the phone with them and just understand things more. And so the kind of short-term bogey, if you will, that we would like them to meet is that the manager for 4 quarters. So if you think about from Q3 of last year to Q3 of this year, that they have exceeded their benchmark and their peer median. And I apologize, I'm noticing that some of the label was cut off at the bottom, that they exceed their benchmark and their peer median. And then the second bogey for them to hit is that on a rolling 2-year period. So a similar situation. So 2 years from today would be 2019 on that rolling 2-year period that they've exceeded their index. So this lists out all the managers. You'll see, if we kind of go left to right, you'll see the quarterly returns, what the index returns were, what the under overperformance and what the median was. And then if you look at the 2-year column, that'll show the 2-year return and what the index was and what the under and over performance for them were. I won't go through all of it because it's for all of your private market managers, but I'll pause before we talk about brokerage and see if there's any questions.
Nope, I have no question.
Okay, great. So Sue, if we could quickly go to page 102. I'm sorry, Sue, 101. So this is your year-to-date brokerage report. Happy to report most of your managers are meeting and or exceeding their brokerage goals for the year. At the end of the year, we do the big report where it kind of lists out all the brokers and what brokers they use, what percentages of brokerage commissions they met. One manager I want to bring your attention to is Systematic. I'm sorry, Christina, did you have a question?
Nope, I'm sorry.
Okay, no worries. So Systematic right now is trading only around 15% with minority brokers. That number could be a little bit distorted because they have not, at the time we needed to get to the performance report, they did not send in their brokerage commission, but that might be just a manager to just keep an eye on, if you will, because historically they have had maybe needed a little bit more coercing to do brokerage trading and to meet your goals. And then
Can you follow up with Sue to give us an update?
Sure.
Since they have probably by now been able to figure out what their 930 numbers should be.
Sure, I absolutely can.
Okay, thank you.
No problem. And then can we go to page 103? So this is a snapshot of your private market portfolio. I just want to hit a couple of key points in it. So the fund is invested in 3 private market asset classes: private debt, which is those managers that hold debt, essentially make loans to privately held companies. Private equity are your managers that hold equity stake or ownership in private companies. And then real estate, your managers that buy buildings and etc. So if we kind of go over from left to right, and I'll start with private debt for the quarter to date. So just remember that private markets, because of the way valuations kind of happen and the way we get reporting from these type of managers, this is reported on a quarter lag. So even though the overall report is as of Q3, this specific report is as of Q2, June. And then next quarter will come in with the numbers as of September. And so you'll see all of your private debt for the trailing, actually all of your manager or all of your asset classes for the trailing periods have been positive. I'll focus on that column that says SIIRR. So what that is representative of is your since inception IRR. And since inception is exactly that, since the beginning of this portfolio, how you all have returned. And you'll see that you've had some pretty positive returns within the portfolio relative to real estate and private equity. You'll see that your private debt portfolio is a little bit less as far as returns goes. That's just because that's a newer portfolio for you all. So you all started investing in private debt maybe about 3-4 years ago, so that it's not in its infancy, but it's a newer, 5 years ago, it's a newer portfolio for you all. And then if we could just spend a little bit of time on that next column over that says multiples. And what these multiples within in private debt, multiples kind of help you evaluate performance on a real dollar to dollar basis. So if we look at that DPI column, effectively what that means is that for every dollar you've paid in, how much have you gotten back to meet or gotten back in a distribution? So with these managers, private debt, for example, once the loan is paid back from the company that they're invested in, they distribute some of those returns back to you. Some are reinvested, some are distributed back to you. For a plan like you all who aren't over 100% funded, that's incredibly crucial because those are dollars, real dollars that you all can use to offset some of your pension obligations for the quarter or for the month. So the way to read this is if we look at private debt, the DPI is 0.35. So effectively what that means is as of this time period, so as of June, for every dollar that you have invested with this fund, you've gotten roughly around 35 cents back for it. And you'll see private equity, the DPI is higher because it's a more mature portfolio. So for every dollar you've invested, you've gotten roughly around $1.20 back over the life of your portfolio. And up top, you'll see kind of the breakdown of how you all are exposed within your private market portfolio. So how much private debt, private equity, real estate that you all have in the portfolio is broken down up top. Unless there's an interest in going deeper in the private markets, we could, or any specific questions, we could go to page 136, which talks about October. Great. So I will keep this incredibly quick because this is preliminary performance. But for the one month period ending October, so this is the fund's most recent performance report, you'll see that the fund report returned roughly 2.2%, which matched your policy index for the month. If we look over at that 3, 5, and 10-year number, you'll see that you're meeting your actuarial rate of returns. And then if we look at the fiscal year return, you'll see that you're slightly above your policy index. So if there are no specific manager questions, that kind of concludes my formal comments on performance.
Thank you so much.
No problem.
Are there any questions? Sue, is this the only thing on the agenda today?
That's correct.
If there are no questions, I thank everyone. I would like to get a motion to adjourn.
I would like to make a motion to adjourn the meeting today.
Is there
Goodwin,
a-
second.
All those in favor?
Aye.
Thanks, everyone, and have a blessed Thanksgiving.
Okay, safe
Thank you,
night.
everyone.
Thank you.
Bye.
Bye.
Sheila,
Bye.
Doris, and Louis, could you hang on for a minute? Sheila, Doris.